Have you ever considered what truly shapes the financial value of the rich soil that helps feed our world? This enduring asset, farmland, often appears stable, yet its market worth can experience significant shifts. Understanding these movements is key to appreciating agricultural investments. Simply put, higher grain prices generally lead to an increase in agricultural land worth, while lower grain prices can put downward pressure on land values. This direct correlation is a fundamental principle in agricultural economics, reflecting the immediate profitability of farming itself. The core mechanism linking grain prices to land worth lies in farm income and profitability. When the market price for corn, soybeans, wheat, or other major crops rises, farmers typically see a boost in their revenue for each bushel harvested. This improved income translates into higher potential profits, which in turn enhances the ability of farmers to afford land purchases or pay higher cash rents for leased land. Landlords, seeing increased tenant profitability, can justify charging more for their acreage. This increased income stream makes farmland a more attractive and competitive investment, driving up its perceived and actual value. To understand this impact, prospective buyers often use a concept called capitalization rate. This rate considers the net operating income generated by the land in relation to its market value, helping to assess the return on investment. Furthermore, it is not just current prices but also the long-term outlook for commodity markets that influences these decisions. Sustained high prices or a positive forecast encourage expansion and investment in land, while prolonged periods of low prices can lead to a more cautious approach, affecting land transactions and values. Beyond the immediate cash flow, grain prices also influence broader market sentiment and lender confidence. When agricultural commodities are strong, financial institutions may be more willing to lend for farmland purchases, potentially at more favorable terms, further stimulating demand. Conversely, struggling commodity markets can tighten credit conditions. It is important to remember that this relationship is dynamic, with global supply and demand, weather patterns, and even geopolitical events constantly influencing grain market volatility. Therefore, assessing land worth requires looking at these prices alongside other factors like soil quality, location, and local economic conditions. Ultimately, the strong connection between grain prices and agricultural land worth highlights how the global demand for food directly translates into tangible asset value. By understanding this relationship, investors and landowners can better appreciate the forces at play and make more informed decisions about this vital and productive asset.